Hand reaches for a book. The dim light catches the spine. The Jewish phenomenon. A pattern. Pages turn. The algorithm is there. Capital allocation, risk management, intergenerational transfer. No secret. Just code. Marriage contracts on paper. Charity rules in ink. Savings in ledgers. That's the system. It works. So why call it a secret? Because a working system, when invisible, looks like magic. But magic is just a label for a process we haven't decoded. This one is decoded. It's on paper. In this library. So who's reading? England, 1290. A royal decree strips every Jew of land, home, and legal standing overnight. Portable wealth. They can't own land. So they build a system around liquid assets, credit, and skills that fit in a saddlebag. Necessity engineered the secret. Land was the anchor of medieval wealth. It's fixed, visible, taxable, and locked to inheritance laws that favored one son. Jews worked around it. Liquid capital. Credit networks formed across cities, moving money faster than any crop cycle. A reputation that traveled. The church forbade charging interest to Christians. That created a gap Jewish lenders filled, stepping into a role no one else could take. Business, not charity. This system wasn't a secret. It was a survival algorithm written into marriage contracts and community funds. But it came with a price. Every loan made enemies. Kings borrowed hugely, then expelled the lenders to cancel the debt. The pattern repeats. Spain, 1492. Portugal, 1497. France, multiple dates. Each expulsion carried the same logic. Portable wealth moved with the people. That's the Jewish secret, not magic. A set of structured responses to enforced mobility. Necessity. But necessity has a breaking point. When does a survival strategy turn into a trap for the next generation? That's the question. A finger traces Hebrew letters on yellowed parchment. The Talmud isn't a prayer book. It's a legal operating system for a people without land. Every page wrestles with one question. How do you trust someone you've never met? Contracts, partnerships, loans. The rabbis built a framework around obligation, not charity. They banned interest between Jews. That's a hard no. But they didn't ban profit. They built a risk-sharing engine called Iska. One party provides capital, the other labor. Losses split, gains shared. No one walks away with nothing. A hand flips pages, stopping at a diagram of four partners pooling money for a trade caravan. The Talmud says each partner can withdraw at any time without penalty, except for lost opportunity. That's a trust reset button. If the deal goes south, nobody gets sued into poverty. The system absorbed failure. A stack of printed simulation charts sits on the desk. You see a curve. Jewish communities in medieval Cairo had lower default rates than any royal treasury. The reason? Social collateral. If you cheated a partner, you lost your seat at the weekly prayer minyan. Shame backed the contract. The synagogue was the debt collection agency. A glass of water catches the overhead light. The prohibition on interest forced Jews to invent equity-like instruments centuries before the stock market. No interest means no compounding debt spiral. Instead, they used Hater Iska, a loophole that turned a loan into a partial partnership. The lender gets a share of the profit, but also a share of the loss. Skin in the game. A pen scratches notes in the margin of a printout. This isn't abstract theology. It's a capital allocation system that outperformed feudal economies because it spread risk across a network, not a single monarch. When a plague or a pogrom wiped out one city, credit lines shifted to the next community. The Talmudic risk engine never stopped spinning. A window frames a dark street. The system had a flaw. It worked only inside the tribe. Outsiders were charged interest. That was the rule. But inside, trust scaled. And when the ghetto walls fell, that trust became a portable asset, carried in the same saddlebags as the scrolls. So what happens when you take that engine, transplant it into a modern economy, and turn up the speed? A ledger sits open on a wooden table. Its pages hold the names of every family in this shtetl. 23 households, each with a number beside their name. That number is their obligation. The community hall smells of dust and candle wax. People file in, dropping coins into a cloth pouch. No one gives out of pity. They give because the law demands it. Every Jewish community ran a public fund called the Kuppah. It collected from the well-off and distributed to the poor. But here's the twist. It also gave loans. A hand reaches for a pen and marks a new entry. A baker needs 200 rubles to buy flour before the holiday. He signs his name in the ledger. No interest, no collateral except his reputation. If he fails, the community doesn't just lose money. They lose a member, so they ensure he succeeds. This wasn't generosity. It was insurance. The cuppa wasn't a charity box. It was a venture capital fund run by committee. Every donation bought a share in the community's resilience. A failed business dragged everyone down. A success lifted them all. The network effect worked because everyone participated. The rich couldn't opt out. The poor couldn't be left behind. Tzedakah wasn't a choice. It was a tax with a return. A child learns to read in the Chloe's building next door. That education came from the same fund. Tomorrow, that child might start a business with a loan from the same ledger. The cycle feeds itself. But what happens when the network fractures? When trust evaporates and the ledger stays blank? The community hall falls silent. A boy flips a page of Talmud. He's 8 years old. His father watches from the back of the room. Chalk dust hangs in the air over wooden desks. Every morning starts the same. Hebrew letters, Aramaic grammar, the logic of a legal dispute between two rabbis who died 1,000 years ago. This isn't prayer, it's training. The boy's brain learns to hold an argument, twist it, test it against a counter-argument. No other culture in 18th century Europe demanded this from its children. The Catholic Church kept scripture in Latin. Peasants learned by rote, not reason. But Jewish law requires every male to read the Torah directly. That single rule created a nation of critical thinkers. A hand reaches for a piece of chalk. The teacher draws a circle on the blackboard. Inside it he writes the number 3. Outside, the number 7. The lesson is about ownership boundaries. The students copy the diagram into their notebooks. They don't know it yet, but they're learning geometry. And fractions. And proportional reasoning. Every harvest festival demands a precise measurement of the etrog. Too small and it's invalid. The rabbis wrote entire treatises on volume calculations. So a Jewish merchant in Amsterdam doesn't just trust his gut. He reads the contract, checks the exchange rate, recalculates the interest. He's been doing this since puberty. Literacy became a compound asset. A man who could read the Torah could also read a bill of lading. A man who could parse a Talmudic debate could parse a partnership agreement. By the 19th century, Jewish literacy rates among men approached 100%. The rest of Europe hovered below 30%. That gap is the education dividend. It didn't pay out overnight. It compounded over centuries. One generation teaches the next. Each adds a layer of skill. The son of a pawnbroker becomes a banker. The grandson becomes a lawyer. The great-grandson sits on a regulatory board. The classroom smells of old paper and wool. A boy stares at the blackboard, trying to understand why the boundary line runs at 3 cubits. He doesn't know he's building the neural pathways that will let him price an option 200 years later. He just knows he has to get the answer right. The teacher wraps the desk with a ruler. Again, he says. The boy picks up his chalk. What happens when a population forced to think this way for 1,000 years enters a global economy built on abstract contracts? A trader grabs a phone off a glass desk. That call connects a startup founder in Tel Aviv to a family office in Zurich. 3,000 years of diaspora infrastructure compressed into a single dial tone. No passport, no customs, just trust. Risk pooling works the same way it did in the shtetl. A venture capitalist spreads capital across 20 companies, knowing 4 will pay for the rest. The modern term is portfolio theory. The ancient term was kupa, a communal fund that covered a member's loss. Both hedge against the same human problem. Portable capital defined Jewish trade for centuries. A merchant could flee persecution and carry his wealth in a ledger, not a chest. Today that's a wire transfer from a Hong Kong hedge fund to a London clearinghouse. Network trust hasn't changed either. The family office doesn't run due diligence on a stranger. It calls its cousin in the same WhatsApp group. The bond isn't legal, it's social. And that social glue didn't erode. It digitized. They don't hire MBAs. They hire minds trained to argue Talmudic logic. Analyze a text, find the contradiction, resolve it, profit. The algorithm runs on hardware built by men who never touched a computer. But can it survive when the glass walls dissolve into code? This isn't a secret. It's a replicable system of structural incentives that anyone can run, regardless of identity, origin, or privilege. The algorithm is portable. It doesn't belong to any one group. It belongs to anyone who understands that capital is a tool, not a birthright, and that networks are your most valuable asset. A Chinese immigrant in Queens knows it. The system is not exclusive. She applies the same capital allocation logic used by a diamond dealer in Antwerp, a venture capitalist in Tel Aviv, or a farmer in Chicago. The system works, but most won't use it. They'll search for a magic pill, a birthright, a hidden ceremony that guarantees wealth without the math, the network, or the discipline. It doesn't exist. The street doesn't care about lineage. It reacts only to the capital you allocate and the trust you build in real time, not to your name or your ancestors. That's the universal takeaway. Understanding the algorithm, applying it consistently, ignoring the noise, and building your own network. So what's stopping you?